Hello, I'm Ron Wilson. In this month's news, the life insurance framework legislation was reintroduced into Parliament in October, with a start date for the reforms pushed back until January 2018. The federal government released more of its controversial legislation covering superannuation reforms, announced in the 2016-17 budget. The RBA left the official cash rate unchanged at 1.5% at its October meeting. In international news, the US Federal Open Market Committee has held the target range for the federal funds rate at 0.25% to 0.5%, while the Bank of Japan announced significant monetary policy changes in a renewed attempt to lift inflationary expectations and economic growth. Michael Pollock has the details.
The revised life insurance framework reform bill was introduced into Parliament during October, with the transition date for advisors to the new remuneration structure delayed until 1 January 2018. The reforms, pushed back from their original start date of 1 July 2017, will address problems with remuneration practices which have led to poor quality life insurance advice to consumers. Among the reforms contained in the draft legislation, a change is aimed at reducing the financial incentives to replace policies where there is no perceived consumer benefit. These include a 3-year phase-down of upfront commissions paid to advisors to a maximum of 60%, and the introduction of a maximum rate for ongoing commissions of 20%, and the introduction of a 2-year upfront commission clawback period, which will claw back 100% of the upfront commission in the first year and 60% of the upfront commission in the second year, should a policy lapse. The government has released its second tranche of draft legislation covering most of the more controversial superannuation reforms announced in the 2016-17 budget. The primary reforms, which, if legislated, that will generally apply from 1 July 2017 are a $1.6 million pension transfer balance limit on the total amount that an individual can transfer into tax-free retirement income streams or pension accounts from 1 July 2017, measures to convert defined benefit income streams to a lump sum figure so they receive commensurate treatment against the $1.6 million pension transfer limit, a reduction in the annual concessional contributions cap to $25,000 regardless of age from 1 July 2017, and a lowering of the income threshold from $300,000 to $250,000 for the purposes of the additional 15% Division 293 tax applied to concessional contributions. At its September meeting, the Federal Open Market Committee maintained the target range for the federal funds rate at 0.25% to 0.5%. In the accompanying press release, it noted, "The stance of monetary policy remains accommodative, thereby supporting further improvement in labour market conditions and a return to 2% inflation." Fed Chair Janet Yellen claimed that labour market conditions were expected to continue strengthening, albeit at a slower than usual pace. The Bank of Japan announced a number of significant changes to the way it will conduct monetary policy, in a renewed attempt to boost inflationary expectations and economic growth. Among the changes, the BOJ stated it would make yield curve control the centrepiece of its new policy framework. It said it would buy 10-year Japanese government bonds so that the yield would hover around 0%, while keeping a lid on short-term rates. There was no change in the official interest rate, as measured by the deposit rate, which remained at -0.1%. Newly appointed RBA Governor Philip Lowe demonstrated policy consistency by announcing an unchanged cash rate of 1.5% at the bank's October meeting. With regard to present economic conditions in Australia, the accompanying media release noted, "The economy is continuing to grow at a moderate rate. The large decline in mining investment is being offset by growth in other areas, including residential construction, public demand and exports." As part of its 2015-16 budget, the federal government announced measures to tighten eligibility for government pensions and allowances. To achieve this, the government proposed new assets test thresholds and an increase to the assets test taper rate from 1 January 2017. While the lower thresholds to qualify for a full pension are as originally announced, the new upper thresholds represent a further drop in the amount of assessable assets, which can be held while still qualifying for some pension. For example, a couple homeowner hoping to qualify for at least a part pension in 2017 will face a cut-off threshold of $816,000 in assets, rather than the earlier projected threshold of $823,000. Currently, a homeowner couple can have up to $1,178,500 in assets before they lose the age pension. ASIC released an updated Regulatory Guide 179, Managed Discretionary Account Services, in late September. This guide sets out how ASIC regulates managed discretionary accounts provided to retail clients under the Corporations Act. The most significant amendment is the removal of the regulated platform no action letter provisions. Providers offering MDAs under this provision are now required to obtain an MDA-specific operation licence by 1 October 2018. In obtaining this authorisation, ASIC indicated it will give consideration to experience gained by those who have been operating limited MDAs. In its annual review 2015-16, the Financial Ombudsman Service, or FOS, reported that it received 34,095 disputes and closed 32,871 disputes during that financial year. These figures reflected a 7% increase on the number of disputes received and a 5% decrease on the number of disputes closed in 2014-15. This increase in disputes was in contrast to a trend of stable dispute numbers over the prior 3 financial years. The primary reason for the rise in the number of disputes received was industry-specific issues in general insurance, which rose 19%.